Good morning, comrades. How are you guys doing today? Today, we're going to be going over my weekly M1 Finance growth portfolio. I'm very excited to show it to you guys. I'm also very excited to show you guys my M1 Finance Roth IRA. In that, I have dividend growth stocks. So I'm very excited to show it to you guys. And let's get started. So we have a $32,000. So my portfolio is $32,975. I believe in my last video, the portfolio was at $33,000. So we had a little bit of a loss, but that's okay. We don't care about week to week or day to day fluctuations. All we care about is growing our portfolio over time. So my three portfolios that I have: QQQ, Tesla, and ARK. And let's go over the holdings tab. So the winner this week, again, just like last week, was Tesla. So Tesla's gain this week was 57.9%. Number two was the QQQ with 14.95%, and the ARK ETF was at 12.77% for an overall return of 22.33%. So I'm very excited that my portfolio is still in the green. A lot of people's portfolios are not. So as long as you're getting that 7 to 10% return, you're doing great. Mine is at 22.3%. I'm very ecstatic about it. And so, going forward, hopefully we keep growing it and growing. The plan, just like last week, was to continually put in $125 each week. So let's just go over that. So on Monday, the 20th, I put in $125 that week. And with that $125, we bought half a share of QQQ. So basically that 125 bought me 0.5 whatever. So I got half a share. And how does M1 Finance determine where to put that money? So if you go to my portfolio in the front, I have certain allocations for each one. We have the actual versus the target allocation. My target allocation for the QQQ is 60, Tesla 20, ARK 20%, and ARK and Tesla are overbalanced, so that whenever any money comes into portfolio, it'll automatically put it into the QQQ. And for whatever reason, if I get earned dividends, it'll also use that dividend money to go towards the underweight holding. So this is my growth portfolio. Compared to last week, my plan is to put $6,000 every single year into this, which I spread it out to $125 payments every single week. I did put more in when the stocks dropped, just so I can get some more value, more bang for my buck. And yeah, so that's about it. So that's my growth portfolio. Just wanted to do a weekly update on that. And now let's talk about my Roth IRA. So in my Roth IRA, we have $11,686. With this, I'm just going to go over all the different holdings. My thought process when building this IRA was that I wanted to put something together that was like a ETF. In my past, let me just go back to, just want to show you guys what my holdings were for this. In my past, I actually had this philosophy of being the lazy investor, where I just put my money in ETFs and just let professionals deal with it. So in the past, so just focus on the right side of the screen here. In the past, I just wanted to put my money into ETFs where you have professional, put the allocations there, and then I don't have to worry about it. And for some people that's okay, but this is something I'm very passionate about, and I really just wanted to build something on my own. And a lot of these ETFs didn't have what I was looking for. What I'm looking for in an ETF was to have like a dividend appreciation fund, which I did have, like a VIG. So VIG is a Vanguard Dividend Appreciation, but they didn't have as much technology exposure as I wanted. So I wanted to build something that had more technology exposure compared to these other dividend paying ETFs. A lot of these other dividend paying ETFs don't do consumer, they just focus on like consumer products. I just wanted to build something a little different. So in building my portfolio, I wanted to have like a higher technology focus. So what did I use to build that? I took the QQQ, which had their allocations in this, as well as the VIG, which had their allocations in this, and I kind of put the two together. So my overall portfolio looks like this. So I'm going to go down to my Roth, and we'll talk about this. So looking at my Roth IRA,
If I put my money in 5 years ago, I would have had 111% return 5 years later. So it comes out to over a 20% return, which is huge. On top of that 20% return, I would have been paid out a 2.7% dividend. That's awesome with a very, very small expense ratio. And the only reason why I even have this expense ratio is I have one international stock whole stock market, excluding the United States ETF. So I just wanted to have at least one thing like that. So going through my portfolio, like I said, I wanted that higher technology exposure because I'm all about innovation technology. And I believe some of the better paying dividend companies will come from tech. So in my tech, 40%, real estate 13, finance 11, industrials 11, healthcare 11, utilities 6, top secret experimental 5%, consumer 4, and communications 3%. So these are all the different allocations, and I'm just going to go through the list just to show you guys what I have. Some of the things you will definitely have seen before, but some of these stocks that I chose also were stocks that a lot of people don't necessarily know about or really don't put into dividend growth portfolios. So just want to show you guys what my portfolio looks like. In my technology sector, we have 16 holdings, 2.3% return. We have Apple, Microsoft, Intuit, Applied Materials, CAS, Cisco, Intel, IBM, NVIDIA, Qualcomm, Texas Instruments, Fluor Systems, NetApp, Oracle, SAP, and Taiwan Semiconductor Manufacturing. Just a quick tidbit about this. A lot of these companies are switching over to cloud computing, and some of these are like producers of semiconductors, which going forward in the future, we're going to want to have fasting processing capabilities, as well as like we are data starved. We just want data so bad. So a lot of these companies are switching over to cloud-based systems, as well as providing software as a service. So that's kind of where I think the future is going. So that's my info tech pie. Next is real estate. We have 10 holdings, 2.8%, American Tower, Avalon Bay Core, Crown Castle, Cyrus One, Digital Realty, Equinox, Prologis, Realty Income, and SBA Communications. Quick, just macro talk about why I chose the holdings that I did. I wanted to have the majority in data centers, just like with my information technology. A lot of these companies, a lot of those information technology companies require places to hold all their data. All this data just doesn't magically just or is held in the air. It needs to be held in data centers. And in these data centers, they hold all the areas. So even though like technically there's cloud computing, it doesn't get invested into a cloud. It gets invested into hardware. And that hardware needs space and cooling and to be like a specific temperature. So a lot of these different real estate investment trusts hold data centers. Also, because 5G is coming out, you will notice there's also a couple cell phone tower leasing real estate investment trusts. And with those, again, with 5G going, some of these companies rent out their tower space to different providers. Then I also have an industrial REIT, a commercial REIT, as well as a residential real estate investment REIT. So these are my 10 holdings. I put them equally. The next sector will be financials. 3.3%, 7 holdings, MasterCard, Visa, Bank of America, JP Morgan, Main Street Capital, Wells Fargo, and Apollo Global Management. So for the most part, a lot of names you've seen before. Some of you will say that these are probably technology companies. You're 100% right, but because I kind of tied in with credit cards, to me that's more of like a financial thing. So I just want to add a little more growth in this sector. I mean, the dividend payout here is great, but I just want to have a little bit more growth. And then I just have some of those bigger, well-known names just to put some more assets under management. So that's my financials. Industrial. 17 holdings, 2.1%. We got Northrop, Old Dominion, Cintas, Republic Services, Automatic Data Processing, CSX, Lockheed Martin, Tetra Tech, Waste Management, Xylem, Insperity, 3M, Caterpillar, Deere, Honeywell, Union Pacific, and UPS. So definitely a lot of names you've seen before, but I also popped in some names that you haven't seen before, just to add a little bit small cap or mid cap exposure. And for the most part, these are companies that I view have a higher chance of increasing their dividend over time. So again, this is only 2% return, which is fine. to me, this is a much better yield than what the bond rates are now. So right now, people will be like, well, why don't you invest in bonds? Because I can get a higher dividend yield as well as capital appreciation on the stocks. So that's why I don't invest in bonds. So just kind of moving down along. So that was the industrial. Healthcare is the next one. Again, you're going to see a lot of great holdings in this one. 18 holdings, 1.7%. Not a huge dividend payer, especially with everything coming out. But we have Vascular Service, Eli Lilly, Hillrom, Stryker, Teleflex, Thermo Fisher, West Pharmaceutical, Zoetis, Gilead Sciences, Bristol Myers, Amgen, Baxter, Johnson Johnson, Medtronic, Merck, Novartis, Novo Nordisk, and Pfizer. So those are my technology, or my healthcare holdings. Utilities, 9 holdings, 3% yield. A lot of people, when they do utility holdings, they primarily stick with electric. I want to put some water. A lot of people don't realize that going ahead into the future, like water is going to be like a huge issue. And I believe the companies that are managing the water systems are going to be producing huge profits because they're the ones that ultimately just they filter out the water, and they're the ones that run the sewer systems and all that. And that's a huge thing. And then also on top of that, you're going to notice I do have those big electric companies, and I also have companies that have renewable energy exposure, because to me that's also the future. I think the oil industry is dead, and I think that it would be a terrible idea to be investing in any type of like oil investments. Next is my top secret experimental. I have 5%. I'm actually not going to go over this one. This is going to be like a separate video. But in consumer, you'll notice that I only have one consumer pie. I put the consumer cyclical with non-cyclical together just so it's a little bit easier for me. And my philosophy, I'm a financial minimalist at heart. I hate spending money on things I don't need. And I just don't want to put a huge allocation in somewhere where I think that a lot of the spending is consumption, where like you pay for things that you really don't need. So 12 holdings, 2% yield. Home Depot, McDonald's, Strategic Education, Nike, Costco, McCormick, Coca-Cola, Hormel, PepsiCo, Procter & Gamble, Starbucks. Ooh, just my girlfriend's consumption alone could fund this entire business. And Walmart. So those are my holdings for that. Again, just compare this to your portfolio. And the last one is communication. This is pretty much an unorthodox communication pie that I built. There's 6 holdings, 2% yield. And some of you are going to say like, wow, that's such a low yield for communication with Verizon and AT&T. A lot of you guys are putting a high percentage of your communications into Verizon and AT&T. Both those companies have a lot of debt, AT&T more so, and I think it would be wiser just to spread it out in companies that have like higher growth that pay less dividend. So I have Activision, Dolby, Comcast, Verizon, Disney, and T. Disney's getting hammered right now, but ultimately in the long run, once those parks start opening up and that streaming service gets better and better, like we're going to see a lot of gain over there. So this is my portfolio. I really appreciate you guys watching, watching me talk about this. And one last thing before I go, I just want to go over my actual gain. So I have 97 total positions. Realistically, should have said there's 12,000 in here, but because when I sold all those ETFs, I lost a little bit of money for that. So my current value is now, it says I'm down 137. It's actually a little bit higher, so I should be down maybe like $200 or $300. So the percentage will be less, but it's all good. So yeah, that's my portfolio. If you guys have any questions, hit me with them. If you guys like this video, give a like, comment, subscribe. Would really mean a lot to me. I appreciate it. And you guys have a great day. So have a great day, comrades. And you guys take care, all right?